Kevin, we've been talking about this low volatility we've been seeing. I just showed a chart earlier in the show about how the VIX is well below its average. It's near a record low. The average, I think, going back to 1990 is about 19.8. We're below 12 at this point. And I know you've been looking at the historical patterns that we tend to see in the month of August, and this is not entirely atypical, right?
No, this isn't atypical at all, because when we look back at last August, we actually hit the lows for the year in August. We actually had a 10 handle on an intraday basis. We hit about 10.88, so it's not unfamiliar to see something like this, but it's also really familiar to see a big spike in volatility. Sometimes we see the height of VIX during August as well. If we go back to 1945 and we've had big market down moves of 5% or more, they happen in August and September. So it's pretty interesting in that regard that August can be both a very calm month as well as a very violent month when it comes to VIX. And what people don't understand is they always say it's a fear index, but it's not the fear index. It's the uncertainty index. And right now there's a lot of certainty around things. With earnings just happened, so people feel comfortable with their positions. We're seeing low trading volumes happen, and so you never want to short in a dull market, and you never want to short a market on its highs. So that's why you're seeing the market creep up a little.
It's essentially a hedging index, right? It's how are people buying insurance against a potential drop?
Exactly, and that's basically what they're doing. And so we like to look at it, and in markets like this, you use VIX as well as other volatility indicators to see if it's bottom or if it's increasing. And what's really telling is that the VVIX has started to creep up from the mid-80s to the low 90s, mid-90s, showing that we are seeing some spikes of VIX coming back into the market. So that's an indicator that it may be coming back, and you look at the curve has about 20 on it towards the end of the year. So you're starting to see some indicators saying VIX may start to come back soon.
Right, and you're maybe one of the people who's keeping the VIX from falling further, or at least because you do recommend right now buying insurance, so to speak, on stock.
Absolutely. It's completely prudent right now, and I think everybody should be doing this, where they can go out and they can buy a put spread on the market through the really volatile months and the seasonality of VIX, because we know that happens as well. So you can go to the end of September, and it expires September 30th. What you do is you actually buy the 2190 put, and then you actually sell the 2070 put against that. It's going to cost you about 20 bucks or what have you. It costs about 1% of where the market is, but it protects you right here from where the market is all the way down to about 5-6%. So you can actually make it through that time, and you would get all of the upside. So it doesn't really cost you much. You've had great moves, and this is the time to put on that type of protection.
Just very quickly here, we talked a little bit about this last week, but what's your #1 risk that would cause that volatility spike drop in stocks?
Yeah, I think oil actually coming down pretty significantly. I also think if the dollar gets a lot stronger, we saw those moves when those two things were working against the market in the beginning of the year. We saw what happened, and that could happen again, especially if we get some bad consumer data coming out of the market as well. That could actually move the market to the downside.